Welcome back, traders and true believers of Forex trading. Welcome to McDuck Trading family. Today we are going to be talking about the importance of risk management. Most traders prefer to pay attention to the profit side of the investment when it comes to trading. It's only one side of the coin, however. Typically, the other side of the coin is linked to money management and the essence of risk. Even though you might not like to admit it, risk is present always and at any time. Risk is the amount of probability of a loss or a series of losses that a trader may encounter while trading on the market. The possibility of a loss happening is as important as the size of the loss itself. Without a doubt, money management is a part of a whole calculation framework designed to prevent financial disaster. It is related to calculating and managing the risk of failure and how to make the most effective use of your resources. There is a trade-off between reward and risk in trading. Neither of these two concepts can be accurately measured, whereas the ratio of risk to reward is a matter of how tolerable you are when it comes to taking risks. When being rewarded, it is in human nature to feel happy, but different traders usually have different thoughts about the level of risk they can tolerate. No profit is guaranteed with trading, but sadly, risk is present at all times. Beginner traders should keep in mind that even a successful trading system is not protected against failure if it does not take risk into account. Money management can make such a system a secure one, but the management of money alone cannot do much to support a system that doesn't work. The first step any trader should make when developing a strategy is to find a reliable system, one which constantly shows a great number of successful trades rather than losses. The system can be based on fundamental indicators, technological indicators, or both. Trading signals tend to combine both of the fundamental and technical indicators in order to get the best of both worlds, and with providers such as TwoStrade, you can come a long way even if you haven't fully developed a trading strategy. In our last video, we did a review of TwoStrade, and I strongly suggest that you check it out, especially if you're a beginner trader that hasn't developed a trading strategy fully. The second step is to determine where the system will trade in markets and what events and indicators it will focus on. The last step is to incorporate those processes and events into a plan, a stage where the money management principles come to life. Now, let's discuss different sorts of risk. In finance, a fundamental idea is the relation between risk and return. The higher the risk a trader is willing to take, the better the potential return. This is because traders deserve to be rewarded for taking extra risk. Reward to risk ratio. What could be regarded as an acceptable risk to reward ratio in Forex trading? Risk-reward ratio of 1 to 3 or 1 to 5 can be reached if you manage to enter a newly emerging trend on time. When you get enough practice, you will be able to identify the top and bottom of the patterns regardless of the time frame in which you trade. Even if you happen to be entering in the middle of the action, the pattern will still be able to provide another major step, and you can make a profit 3 or 5 times greater than your stop loss. There are a couple of issues though. Quite often they don't form a trend. Some trends aren't strong enough to ensure a risk to reward ratio of 1 to 3 or 1 to 5 if you enter them late in the middle phase. Very often the hesitation of entering a trade or not causes you to miss it and get into it too late when the trend actually ends and the price reversal triggers your stop loss. Moving the stop loss is one possible solution. It is advisable not to allow your stop loss to stay at its initial position, but rather to move it as the price action grows. Every trader, of course, must evaluate for himself how much to raise the stop. Unusual risks. Trading and investing are primarily psychological. The movement of economic assets is due in large part to buyers and sellers making rational and irrational decisions. Profiting from this price change is an emotional experience for the trader. An experienced trader must be careful not to be caught in the crowd's emotions, and in many instances, he should act against the crowd even though that is against human nature. Outside interventions may affect the trader's psychological well-being, such as lack of sleep, family hardship, illness, or lack of success. Unfortunately, As failure to succeed starts, loss of confidence follows. The aim of designing a system is to reduce those emotional factors and help traders get back on track, which diminishes its negative effects. Temporal. The risk increases with time. The longer a position is held, the more risky the position is. For this reason, long-term interest rates tend to be higher than short-term rates. On the other hand, profit doesn't increase over time in the markets. A position should therefore not be held beyond the time that the reward ends, in order to reduce risk. Thank you so much for watching. I hope you enjoyed the video. Please like, share and subscribe to the channel, and I will see you soon in the next video.